Okay, good afternoon. This is Brian Shannon from alphatrends.net, and today is Wednesday, June 15th, 2011. Let's take a look at these markets here. Obviously, we had some further downside today. Market S&P was down close to 2%, one and three quarters, I guess. Yesterday, we had a little attempted bounce. That bounce was on lighter volume, and I mentioned on Twitter during the day, ignore the calls that people were saying that. Be careful or ignore the calls that it was on light volume. By that I meant, and I hope I didn't confuse anyone, that it's true only price pays, but when we're in a downtrend, number one, and we're attempting to bounce and we're not getting volume, what it tells us is we still have to maintain a very strong defense. If you're going to trade, and what I was saying was, if you have good prices, just manage risk. That's your job. And managing risk is decisions there are: do we want to take stocks home overnight when the market has run up in a downtrend up to a prior level where we've been finding resistance? In a market where we have a declining 10, 20, 50-day moving average, in a market where we had a prior important low that was breached, and that's where we found this resistance. So the question isn't always black and white, and I apologize if I confused anyone by saying, only price pays, because only price does pay, but volume is important to give us some recognition about what kind of environment are we in. Now, price obviously does that as well. We have a declining market. We're down very close to now the 200-day moving average. That 200-day moving average is the big number that a lot of people have been looking at, 125.86. We also have the lows in the S&P 500 from March, which are 126.18. I was looking at some historical charts I have, and what I did a while ago was took just the S&P 500 and took a look at the 200-day moving average. Now, I haven't updated this, I think, in a year or so, but this is 1999. What I want you to see here is we came down real hard July, August of 1999 and had a huge bounce. So you could have pretty much bought to the penny on that 200-day moving average and made a lot of money real quick over the next couple weeks. But then the next attempt, it wasn't quite so easy. It did get a rally, but then we cut down through it again, and finally the market turned to 2000, and what we saw in there was we got another big bounce from the 200-day moving average, and then we had it kind of hanging around down near there. So generally, when we have an advancing 200-day moving average, that is when the slope is higher, and these are just 2 years so far, generally you do look for a bounce. When that 200-day moving average begins to flatten out or decline like we saw in 2000 here, then we're going to be less suspicious. In 2001, all these rallies fell short of that declining 200-day moving average. That 200-day moving average started to flatten out maybe just a little bit here, and the market came up to it and even through it. But the 200-day moving average was declining in 2002, and the market fell away from there again and spent most of the year not anywhere near that 200-day moving average. 2003, what did we have? The market finally crossed above it. We saw the 200-day moving average turning sideways to higher, and the new rally began in here until we saw what? Well, the first test of that 200-day moving average in, again, about this time of year, about May of 2004, we had the market come down close to, and very similarly close to where we are right now. So close to that 200-day moving average. And then we got a little bit of a bounce. The market came down and touched it once, touched it twice. It had a good rally here for a month or so, and it's basically showing us that this 200-day moving average, there are some times when you get some very good trading opportunities, but what they really tend to indicate a lot more is just a changing nature of the trend, whether it be transitioning to a bearish market or just becoming much choppier like we saw in 2005 when that 200-day moving average was undercut. It tried, it held its resistance a little bit, became support, and you start to see 2005 there were no technical rules the way that this market traded around that moving average. 2006, we came down very fast. Again, look at the month, look at the time of the year. This sell in May, go away type thing. We came down to that 200-day moving average, bounced real hard, then undercut it, spent some time going back and forth, and finally the market got back into gear. 2007, real choppy. The point is, again, that I'm trying to make here, is here we have this 200-day moving average, and this 200-day moving average is a big area that a lot of people are looking for the possibility of a bounce. I'm looking for that possibility as well. I don't think my mind isn't made up that the market's going to bounce at the 200-day moving average. My mind isn't made up that it will undercut that 200-day moving average and test this low of 125.86 lately. That's a possibility. But the fact remains, when we have a market like we have now, with still a declining 5-day moving average, and we're unable to break through important levels of resistance. So that's kind of twice that the market got up to this level and then gapped away from it. So we're showing 130 is obviously has become very heavy area of selling recently. So we would expect if it gets back up there again that it will likely give us similar resistance in that area. But what we're seeing again is we undercut these lows from last week, so we have a lower low. You look at it, and the market really this afternoon really just kind of felt, to me, I thought, very nervous in here. And let's take a look at the ES, because what was going on in there was we were touching S2 numerous times throughout the day, and it seemed like there's a lot of nervousness in that area. The market felt like it wanted to break down right here, but I think that there were a lot of short sellers kind of hoping it was going to break, but nervous that, hey, if it doesn't break, I have to cover. Where are the natural sellers coming into this market? So we've still got a very indecisive market, but with obviously a downward momentum. We're in a downtrend here. There's just no denying that, and we've got this what's an important area of resistance. And before this market can have any type of ability to rally once again, it's going to have to get back up above that level. Let's switch it back to the SPY. But the market in this type of environment, I think that we still have to manage risk by being less active, and when we are involved in the market, having low expectations as far as follow through. The trend is lower, so I think you could look for more follow through to the downside, but then you look how far it gets down, and it really starts to play games with your mind. So that's why smaller share size and just having a little bit tighter trigger, and remembering that this is a more, for me and 99% of the people, I think, trading on the downside of the market is a more difficult environment. There's always someone who's going to say, hey, I love bear markets, I do great in them, and that's what you should concentrate on, and should really be pumping your account up right now. For most people, this is really more of a time of preservation of capital and playing a strong defense to make sure that when the market becomes healthy again, that you have your capital resources intact to take advantage of it, basically. So there's my little speech about the 200-day moving average. I'm going to say the same thing about all these markets, which is we're still heading lower. We've got these big levels below with the 200-day moving average with the March lows. Not necessarily true for all these markets. That is that they're below us, because here we are. We've undercut the 200-day moving average on the Nasdaq. The first touch of that 200-day moving average 2 days ago was 2 pennies. The market came 2 pennies below the 200-day moving average, and had you bought it there and then sold on the open the next day, great trade. If you bought it there and held it, now you're kind of wondering, well, wait a minute, I thought the 200-day moving average is support. It tends to be an area that gets a lot of support in it, but perhaps before the selling's over, we're going to see an undercut of the 53.75-ish area from the March lows. So just because we're at what appears to be an important technical area doesn't mean that we should be being early or being the first one. We want to wait for evidence, and here we saw the market gapped up yesterday above that declining 5-day moving average. There was opportunities to day trade the long side yesterday, but beyond day trades, you just can't trust it when the direction of that 5-day moving average is lower. And one or two of these times we will get a bigger bounce, but until then, you're just going to get these losses that keep adding up. And if you've been trying to buy and hold on the way down, it's really starting to get very painful, I think, for a lot of people. The Russell 2000, this market is just above its 200-day moving average. This one is this whole area in here is an important level for just because basically it's been a heavily contested level in terms of just price support near $77, and we also happen to have the 77.09 is the exact level right now for the simple 200-day moving average. And these moving averages I use are simple; they're not exponential or weighted in any other way beyond just equal value per time period. So the Russell, maybe we get a quick undercut. Maybe it's tomorrow. I hope not, because I'm going to be on a plane headed to Dallas and look forward to seeing people there for the Traders Expo. I hope that you're there. But that this market is feeling like it should have that bounce. Yesterday it kind of looked like it was the beginning, but again, we have these declining 5-day moving averages and these key levels that have been really support turning into resistance and falling short of those. We need to see a pattern stick above a 5-day moving average of higher highs and higher lows, and then we can buy for maybe a 1 to 3, 4, 5-day hold. But right now, it's just still not in the cards. Semiconductors have really, they just come down through number of important levels that people were calling, hey, well, it should find support. It's like it might find support at the 50-day because it was prior resistance. It might find support in this area where it gapped. It might find support at this prior important level. But now, where are we? We're down where it might find support at 32.20, near the 200-day moving average of 32.50. It seems as though we're getting closer and closer to where we're in a position to bounce, but the evidence still isn't there. We're not holding. In all these markets right now, I think 33.60 is probably a real important level for the semis to hold above. This 79.80 is important for the Russell. For the Nasdaq, I think that it's probably the 55.5. S&P 500, really, it's 130 is a huge number right now. Financials continue to bleed out, down 2% today. Greece, we knew about Greece back here, and the market wanted to ignore Greece. Now the market declines and everyone wants to blame Greece. There's sellers in the market, why they're there, how long they've been there, how long they'll stick around. That's always subject to debate, but the damage is clear. We're in downtrends in these markets, and to try to fight them and try to pick the bottoms because we're down too much, or we're at these the retail stocks broke out to all-time highs just 5-6 weeks ago. We were there, and it came down through that resistance, which was support, then the 100-day, the 150, and now we're getting another test of the 200-day moving average. They seem like they should bounce, but they are not bouncing. We have a declining 5-day moving average. We have lower highs and lower lows, and until that pattern changes, the only people who are going to call the bottom are liars, or if you get lucky, but you're going to have to try it so many times that to say that, hey, it's down too much and it's an important level, I'm going to keep buying here or there, and the don't frown average down crowd is suffering heavily here. Maybe the market will bail them out at the 200-day moving average. It has a history of doing that on I was trying to go back to, I'm getting it wrong here, on the like the first test of the 200-day moving average. A lot of times there is that tendency for the market to bail you out. If you're playing that game and you get a good bounce, reassess the market and look at it and say, hey, now I've got to take some risk off, because the market's been telling us actually for a while with all this indecision and downward momentum that these are potential levels of support at these bigger moving averages, but they are not reasons to be involved in the long side. I'm not going to take a look at any individual stocks right now. I think they're too heavily damaged to really be looking at with any seriousness. So that's going to do it. hope everyone is surviving this market okay, and maybe some of you are really knocking it out of the park on the short side. If so, good for you. That's awesome. So anyways, thanks for tuning in, and I'll talk to you another time.